Welcome everybody to tonight's Startup Stories event about the topic Fundraising Fundamentals. We always had many questions regarding fundraising and how to finance a self-employed life in our past Startup Stories events. So we thought, why not do a whole event on that topic and hear from experts about their experiences. So I welcome you in the name of Startup Campus. Startup Campus is led by ZHAW and Impact Hub Zurich, and we are a powerful consortium of different higher education institutions and different players from the startup ecosystem. And this semester, we also partnered with a startup, Nikin, and this is our contribution of these events. We planned one tree per participant for each event. So now we're at 92, so I hope we'll get to 100 trees planted for this event tonight. Before we start, I quickly run you through the agenda. So first we have a little warm-up quiz where you can get engaged and show your knowledge about the fundraising landscape. Then we will hear an overview by the Swiss Startup Association about what kind of investors are out there and who could help you with funding your startup. Then we will hear a first keynote by Désirée Dosch. She's an investor herself and also a founder at Alvicus AG. And then we will hear a second keynote speech by Michael Hagander. He's the co-founder of Microcaps, and they managed to raise over 5 million Swiss francs this year. So first-hand insights. After the two speeches, we will have a Q&A where you can address your questions to either or both of the speakers. And in the end, we will tell you what we are doing to help you found your startup. It's always very important for us to have your feedback. So I already ask you to scan the QR code or click on the link in the chat. It will also be sent tomorrow. And so you already have it open in case you leave earlier or you want to write down your insights during the event. For the feedback, you can also receive a free co-working day at Impact Hub and a coffee at our cafe. And with this, I want to start with the warm-up. So maybe this will be a bit out of place in case you didn't research about this topic. But how much capital do you think was invested in Swiss startups last year in 2020? You can write your guesses in the chat in millions Swiss francs.
So we have from 375 million, 26 million, 1,200 million. We have basically a huge range. Lots of people in the area of 500 to 600 million Swiss francs.
Okay, so it is actually more than most of you guessed. It's more than 2 billion, so 2,124 millions to be precise. So I think most of you guessed less, so quite good chances to get some funding if you found a startup. And with this, I would give the word to Ariana from Swiss Startup Association to give a short input about the fundraising landscape. Ariana, are you here?
I'm here. Thank you so much.
Thank you. Welcome.
Thank you. Let me share my screen. Will somebody, oh, no, not like that. Will somebody give me a thumbs up if you can see the presentation? Thank you so much. Perfect. So I'll keep it very brief. I have 5 to 6 minutes to let you know how fundraising works. So I'm Ariana. I'm an investor myself. I run Dart Labs. We're an accelerator here in Switzerland, connecting Swiss startups to the US ecosystem. I'm an entrepreneur myself. I sit on several startup boards. I sometimes do public speaking, and I lead a CES at HAWZ in Zurich called Disruptive Technologies. Who's the Swiss Startup Association? We're an umbrella organization for the Swiss startup ecosystem. Our main goals are not just more startups, but mostly also better conditions for existing startups. So the main question that you want to hear about, where to get money or funding as a startup in Switzerland. There are three main types of investors. One being incubators and accelerators, so the category that I fit in myself. There are really many different forms. Most of them focus on the early stages, so pre-seed and seed. And most provide support and some form of financing, dilutive or non-dilutive. So meaning they take shares in your company, or they might just provide free support and free money. Then there's business angels. We have one example with Thomas Dübendorfer, who's definitely one of the more prominent members of the community, a former Googler and one of the founders of SICTIC. SICTIC is one of Switzerland's, I think, biggest angel network communities. So business angels are private individuals, often entrepreneurs themselves, or have some connection to the startup ecosystem, have worked for startups, have founded startups themselves, and they invest their own private money. Most of the time, along with their financial investment comes access to their knowledge and their network. They're usually very engaged investors, which is really great for early stage and young startups. And venture capitalists, of course, probably the most prominent group in this ecosystem. Here, the example of Swisscom Ventures, which is a corporate fund, and then there's a lot of different private funds like Verve Capital or Red Alpine, etc. There's, I think, currently about 35 active ones in Switzerland, and now I'm not counting the venture, the CVCs, so the corporate ones like Swisscom Ventures. When is the right time to get some access to this money, or when does it make sense to engage? Here it says pre-seed is the ideation stage, and usually self-funded. That used to be the case, though. Of external funding and financing is going more and more into pre-seed. We ourselves at DART invest in pre-seed. A lot of angels are already investing at pre-seed. So it is no longer that pre-seed means you have your ideas in a business plan and slides and are funded through your own funds and friends and family, but more and more professional or already angel investors are coming in at that earlier stage. Then there's the seed stage, considered the early stage. This is a very crowded space here in Switzerland with a lot of funds and angels that are in this space. To maybe give you an idea about ticket sizes, usually pre-seed, the startups are looking to raise somewhere between a couple of $100,000 and maybe 500 to 700,000. In a seed stage, most of the time, it can be between 750,000 all the way up to a few million. We actually have one startup right now that is classified as seed, but is raising 6 million. We've also seen A rounds of 6 million. So as you see, this is quite fluid between the stages. Series A or B meant for build, there's usually traction here. You have some customers and now you need money to grow your company to scale quickly. And then growth series C and D that we don't hear that much of in Switzerland, but are more common in the Silicon Valley. The mega rounds of a few $100,000 that are really meant for global scaling. How do you get some of that money? Well, you need a really crisp idea and a big vision, a team that at least can carry the next few months or this phase of the startup, and an idea on how you're stock up or build out your team. You need some kind of unfair advantage, being some amazing IP or technology that you've developed, or something that sets you apart for the competition, and you need to be able to communicate that. You need a solid business plan. Some investors might argue on that. For the past few years, we've been telling people, no, you don't need a business plan. This is old school. I am a big fan of business plans. Even if you never share it with anybody, it forces you to really think through all areas of your business, and I think is a really valuable exercise. And then you need a really thrilling pitch deck. You need to, in 10 to 12 slides, be able to communicate that crisp idea and vision, tell us why you're the right team, and what sets you apart from everybody else who is trying. So that's it. Thank you so much for listening. You can reach me at ariana@dartlabs.io if you have any further questions. I'm very happy to answer them. And thanks for having me here today.
Thank you very much, Ariana. That was actually the perfect overview. And I also know, since I'm only involved in this startup ecosystem since around 1 or 2 years, how complicated it can be. So it's always good to have a bit of an overview first. Thank you.
You're welcome. My pleasure.
So, next we have Désirée Dosch from Alvicus, also presenting her side as an investor perspective. Désirée, I give the word to you.
Thank you very, very much, Ariane. I will just start sharing my short presentation, which you should actually see now. Welcome everyone and good evening also from my side. I'm very, very happy to be here tonight to share with you my very personal story as well on how I became an investor and what elements and factors are actually, for me personally, very important when I screen a startup or look into a startup in more detail to potentially invest in it. Who am I? My name is Désirée. I'm not only not only just an investor, I'm also co-founder of a consulting firm, which is based here in Switzerland, but we have mandates also in Europe, Germany, and also in the UK. We are mainly focusing on growth and segment strategies, not only for startups, but also for bigger corporations. But we are tonight not here to talk about my consulting firm and my entrepreneurial career, but really my investment and investor career, which started a couple of years ago. And that's why I would like to run you right away into the topic and start actually with and maybe different to some others, it didn't really start with a planned idea or a planned action that I grew up in the morning and thought today I become an investor. It was very accidentally, and it was an opportunity that actually has been brought to me at a time where I actually started also to become an entrepreneur. So, which was kind of like a trade-off to see if I want to invest that money also at the same time into another company while I'm just building up my own one. But I took the chance because I just really, really much believed into the idea and in the potential. Also because at that time I was strongly involved in that theme and in that industry, and I knew the market very well, and I was convinced that there is a need out in the market. And I was convinced that is something that really will also change the future of our society. And that's why I decided to start and take that risk and do that investment. So it was at that point in time more maybe a gut feeling than really a proper screening process. And today that evaluation process has been a bit more standardized, a bit more fact-oriented as well than it probably started with my first investment. Another very big factor, but also at that time, was really the topic of impact. And this doesn't mean just sustainability or any other trendy word that's being flying around at the moment a lot. It was just really anything that helps the society, our globe, our planet, our economy, and our country to become a better place and to evolve and to actually be and stay competitive in a global market. So, because I truly believe in the fact that the future will evolve even faster than it has evolved in the past. And for a small country like Switzerland, I personally believe it's very, very important that we stay innovative and that we have young, motivated entrepreneurs who come up with ideas because only with those we will be able to also stay competitive in a global landscape. Another reason for me was also at that point, which goes into the impact, was because I wanted to always be the driver of my life, but also a kind of like a driver of the future. And for me, it was very clear actually since many, many years that I want to become an entrepreneur, that I want to become also maybe an investor. That wasn't really my plan, but it is nowadays the case. But the really reason for it was because I just didn't want to just be a passenger seat and being driven into my future. I wanted really to share, inform, and be able to impact the future of the planet I'm living in, or the country I'm living in, by myself as well, a little bit at least. And last but not least, of course, the reward. Here it is illustrated with a little dollar sign. Of course, I'm not doing this just only because of passion and love. I also do it with the hope in the long run to have a little side effect and earning some money out of it. But this is just one side of the reward. I think another side of the reward for me is really also to be part of a growing business. And I think there are so many ideas out there. I personally myself wouldn't be able to fund them all. And I'm probably not the real kind of like founder of a real startup. That's why I just think it is nice as an investor to be able to help multiple firms and companies and startups to help them fulfill their dreams, to help them fulfill their vision, and support them in growing their own business into the future. And I think that's like one big reward to see, is definitely to see that, yeah, to see something grow, to see something becoming big and being successful. I think this is just really, really amazing and something great to see. Nowadays, I just mentioned our onboarding process, or our screening process, has been developed over the last few years a little bit. Here you can see kind of like 6 high-level themes that we are always looking into. Not all of them have the same weight. And it depends also a little bit on the startup or the company that we are looking at. They might vary from time to time a little bit, but more me personally, still it is from the left to the right, kind of like the importance. Starting with the founder, I think that's one of the very, very key elements. These are the people who actually came up with the idea. For me as an investor, it's really, really important to understand why they came up with the idea, how the idea started to exist, or how it evolved and has been developed, because that's actually the driver of the whole machine afterwards. And if I can totally relate with that passion and vision, I think that's one of the most important things and factors to really hook me in. I think that story is really important. It doesn't have always to be a very, exciting story, like sitting in a bar and having just coming up with a very simple idea can also be very, very nice and very good. So it doesn't have to be a very createful story, but I think it's important to really be able to tell the story. For me as an investor, this is very important. And then I think the next level is really also the team, because the team, and especially the people who join the company or a startup in the first stage, they have usually a huge loyalty, often also share the mission and vision of the startup very, very much, even though they haven't been founders of it. But I think it's here really very important to also see those people, but also have a look at the skills. And I think here, for me, the soft and hard skills are very important. For me, it's also very important how the founders and the first mover employees are actually interacting, because for me, just the leader is not enough. The followers are very important as well, and actually they make it work at the end. So it is important that that kind of like ecosystem between the founder and the first employee is really working and is kind of like harmonic and has the same goal and vision working towards it. This is for me something very important and usually very much appreciated also, to be able to meet the team and to see who is involved, who are they, why, what's their motivation to be part of it. That's very important for me as well still today. Industry, the product, of course, a key element to look at. You can do here a lot of screening and SWOT analysis and coming all with all the data showing how big the market potential is. I think that's one side of it. But for me, very key here is actually to very, very simply understand what kind of need in our economy or in our society the product service is actually solving. That's for me kind of like the focus when I look at a product or a service. I always also ask around to figure out if my friends and families or my environment would actually buy and purchase such a thing, would spend money on that kind of good or service, to just figure out, is this really something our society is looking for? Does it simplify life? Does it increase confidence or convenience? So here I'm really much on the solution of the product interested in. What is the strategy of the company? Of course, this is very, very important. I'm totally with Ariana that business plans are very important. I really want to see different scenarios as well. And not just the nice and beautiful ones, also maybe what is if there is something like Corona hitting, when there is a crisis, how do we face or have an idea to challenge these or make them work, and kind of like find a way around. Very important also when it goes into the business model, of course, with the scalability. What is there the plan, and how do you want to grow and grow also your business in the short, mid and long term. And last but not least, I'm very much also a person who probably questions and asks a lot in the beginning when I do the screening, and one of it is always, what are the challenges? I really want to understand the challenges that a company had in the past. Think about as well challenges, what have been or what are the challenges you might face in the future, because I think that's really important to understand them, also transparently share them with your investors, because no company is perfect, doesn't matter how big or small it is. Important to be aware of the challenges or the difficulties you face, and also be able to ask for the right help. And this is also very much in the early stage, something which I appreciate, because we invest very much in an early stage, pre-seed and seed rounds. And if companies share with us the challenges, we can also see if we have maybe skills or a network or anything else that might help them to reduce those challenges a little bit. So therefore, this is for me very important, and just also something that shows authenticity to the founders and the company. So in summary, it's very simple. People are very important. I think I just personally have totally to connect to the people. I also really want to see from the founders and first mover employees to see how they actually, what risk they provide to the company. It's important to me to really see that they live for their dream and it is kind of like their life. If they have kind of like a safety net on the side and it's not, they're not so much thrilled to make it a success, that's for me already kind of like something to be careful of, because then I don't believe in that they have to believe in themselves that this is something that's really needed. So I really want to see how much they risk and give in to really make that a success. Impact, see the good. It needs to somehow make our lives better, easier, simpler, nicer, whatever. But it needs to have an impact, and best would be, of course, a sustainable impact for our society and country and economy. And last but not least, because I'm not doing it because I'm just hugely rich, I do it because I want at some point to earn money with it as well. At least that would be nice. So scalability is definitely something to look at. It doesn't have always to be kind of like we need to go on a global scale, but at least really have the approach or the vision to really scale into multiple markets or into different countries or whatever it might be, or to have a digital product that you can scale massively. So these are kind of like my little insights in a few minutes about me as an investor and about the companies and the process I follow when I'm looking into startups. I think what I really would like to share at the end is also the way we invest, and we have three ways, or we have three things that actually fit our purpose also as being consultants. Either we do angel investments, but also then we are somehow would like to be involved either with a network or our know-how. We want to have an active role in the company because I think that's just also the nice part of it. And we also do from time to time work for equity, because I know how difficult it is to grow a startup, and it is kind of like a chicken and an egg in the beginning. No money, but you need to grow, so you need to have skills. But you can't really pay these skills. So I totally understand that one, and that's why I think work for equity is a nice way of evolving and help to grow a startup to get to the next level. And of course, from time to time, it can also be a combination out of it. And with that, I would just let you all know who actually think about starting a business, do it. I think if you really believe in your idea, go out, try it out as soon as possible. Try it, because I think it's a huge reward to see how something grows. And if even though if it's not successful, it's an amazing experience, and it's probably something you will never learn better and faster than when you become self-employed or an entrepreneur. So with that, thank you very much. And if any one of you has any questions or want to get in touch, please feel free. You can see my email address here, or you can also easily and very happy to connect with me on LinkedIn anytime. So thanks for having me, and I'm looking forward to the Q&A session later on.
My name is Michael. I'm the co-founder of Microcaps. I have a background in mechanical engineering. I'm saying this because financing round is really not where I was I was trained in. So that's to give you a good feeling in case you neither haven't. You can learn it. It's absolutely doable. Yes, I'm co-founder and co-CEO of Microcaps. About Microcaps, we're an ETH Zurich spin-off founded in 2019. We have raised our seed round, a 5 million round in December 2020, so a couple of months ago, and we are now 18 full-time employees, so growing rather fast. One first notion here, and that is a remark on the first speech we heard. So we managed to finance our startup through grants and competition money, and without any equity investments for almost 2 years, which was great for us, because it gave us a great sort of head start to head into the first financial round. So we had a lot of stuff to show once we needed investor money. So I can highly recommend to look into competition grants, etc. That are available. There's a lot. The ecosystem in Switzerland is absolutely fantastic in this respect, so I highly recommend you to do that. Cool. I would like to focus on the things that looking back a year from now, I wish someone would have told me. So I got a lot of coaching on how to pitch your startup, what investors want to hear, but then very little on the actual process and the actual technicalities of a financing round, and how all of this actually works. So I woit like to give some thoughts on that and share a little bit of my experience. This is a personal experience, so it can be completely different for others, but that I guess is the case for everyone. So on financing round, first question to ask is really why, what for, and how much money do you need? Then the second question I would like to focus on is who is your dream investors. What kind of investor would you like to have? And then a couple of topics that are important. So one is on valuation, then on financials, process of a financing round. So how does it work from the first pitch to actually receiving money on your account? And then a word on shareholders agreements. Overall, my tip to all of you is talk and work with someone who has done this before, because there's so many things to consider. We could easily spend an entire day on this topic. So it really helps if you can work with someone who has done it before, and that doesn't matter in which stage you are. So we were lucky enough to have an experienced advisor who has built a startup from scratch and sold it to a big corporate after a Series C or D. So he has gone through all the stages and was able to help us on the way. It's honestly a little bit of a nightmare without that. So really talk to someone who has done it before. If you don't know anyone, shoot me an email. I can help out and connect you, or maybe even answer the questions you have. So the first question, why, how much, and what for? So the big question you need to ask yourself is, what is your next value inflection point? So what is the next milestone that you have to reach as a company that will increase your value? And this doesn't really matter in which stage you are. If it's pre-seed or if it's growth, there's always a next value inflection point. So first thing is figure out what that is. Then the next question is, how much money do you need to get to this value inflection point? So that goes into resources, time, materials, spaces. This can be, if you're a pharma startup, it's typically then the preclinical trials. If you're at the later stage, it's clinics, phase 1, or whatever. You need to figure out how much money you need to get there. And then it helps to maybe not double the figure you've come up with, but increasing it by quite a significant amount, because I guarantee you will need more than what you calculate on your scrapbook. And then it also helps to, from the start, ask the question, what comes next? Once you've reached it, what is next? Because if you, from the beginning, talk to the right partners and the right investors, you can line up then for the next stage already, and don't have to start completely from scratch. So a couple of take-homes. Now, this being said, that was in our case after almost, so we've already existed for a year as a company, and the round was 2 years in after our founding. So what we did, what really helped was we made a 5-year roadmap with milestones. So a plan. We heard before, some people think you don't need a business plan. I strongly agree with the statement that you do need one. There is this cliche saying, if you fail to plan, you plan to fail. I think that's absolutely right. If you don't have a plan, there's no chance you can follow through with something. Also, it shows a high level of professionalism. If you have a proper business plan, then the business plan templates typically also force you to think about topics that might have not come up yet, but that are really, really important because they belong in a business plan. So you need to think of them. Then the second thing we did is we then made a financial plan that fits this 5-year roadmap. So how many people do we need? How much is this all going to cost? We actually did a discounted cash flow model, which was maybe a little bit of an overkill, but it then really helped in stating our point in the question of valuation, because it's also a tool to generate a valuation. Granted, in early stage startups, it's really just art and not a lot of science, because you're making up all the numbers. It's all in the future. So you can make up whatever number you want. You just then have to argue why these numbers are going to be correct. And then the last thing I already said is you will always need more than what you in the beginning think. Cool. Then the next question, who is your dream investor? There is a cliche saying that you might hear, but the relationship with an investor is like a marriage. I was told that once, and I think I'm not married, but I think there's probably some truth to it. So once you sign this shareholder agreement, you cannot after 6 months say, well, this didn't work out and split. Because then a part of the company belongs to your investors, so they're there to stay. So you have to either buy back the shares, which is typically impossible for founders, or then go through a very, very expensive and frustrating process of sorting everything out. So it's worth spending time on this question with whom you want to work together. Then what kind of investor do you need? We've heard some background on this. There's strategic investors, which are typically corporates that look into technologies or ideas that help their own business. There's the institutional ones that are, VCs that do this professionally. Private investors like business angels, but there's also foundations like the ETH Zurich Foundation or the Lichtsteiner Foundation. They invest in companies. They did participate in our round. And then there's grants. Every now and then you read about financing round that is 50% done by a venture capitalist, and the other half is a Eurostar grant or a Horizon 2020 grant, which is a good way of moving forward. These grants can be multiple millions, so it's really worth looking into that. The question you should ask yourself is, what is the plan of an investor with you? Well, the straightforward answer might be, yeah, well, it's their business, they want to make some money, but there's a lot more to this question. So with venture capital, it's typically not their own money, so it's a fund. So at one point they have to give the money back to their investors. So a question that comes up is, how long is the runtime of this fund that is investing in me? If it's only 2 more years, then you already know they need an exit in 2 years. If it's 10 years or even an evergreen fund, the timeline is a lot longer. So it's really worth talking openly about this with potential investors, what their plan is. Then a question that I found very helpful is, are your investors interested and capable of doing follow-up investments? Because eventually you're going to need a second financing round, and it really helps if all of your existing investors can participate again, because then you don't start from scratch, but you already have a good head start on who is going to participate in your next round. So that's also a very fair question to ask to your investor. And then the third one, which we were looking into, was what is the added value of the investor beyond the financial support? So can they provide network? Are they willing to help in bashing sessions, helping you on specific topics? Are they experienced in for example, supply chain and help you out? Can they open doors with customers, and are they willing to do that? So there's a lot more than just money in financing rounds. Again, some important takeaways for us, and the first one is work with professional or experienced people. They will tend to ask the difficult and hard to answer questions because they have the experience, and that is good. That is uncomfortable at first, but if you get a question from an experienced investor and you cannot answer it, that's a good thing, because he forces you to think of it, and if he's asking about it, it's important. So it doesn't help if you spend 2 years barking up the wrong tree and nobody tells you. It's not going to work out. So it's good to have experienced people that ask the hard questions. Then the second one, which is very, very important, you need to get a lead investor first. and ask for term sheets rather quickly. I cannot tell you how many times during the last year I heard the sentence, "We really like what you're doing, we're really interesting," and nothing ever happened out of it. So push for who will be the lead investor, work closely and intensely with them, and the ones that are co-investors will follow the lead investor's decision. So whenever you hear, yeah, we're interested in maybe doing a co-investment, who is going to be the lead investor, it's perfectly fine to say, thank you very much for your interest. I will contact you again once we have a lead investor, and then don't spend any more time on it. I have wasted a lot of time, giving info and pitches to potential co-investors who then just jumped the boat because they didn't want to put a signature on a piece of paper. Then the next one is get a so-called warm introduction whenever you can. So blind calls typically don't work when it comes to investment. So whenever you have a connection or whatever connection you can come up with, try to use it. It makes a huge difference. And we've been told that, and I have experienced the same. And then another topic, which might sound weird, but I've been asked this a lot. Can you just take a bank loan for an investment? I would absolutely not do this. There's a simple reason. Credit comes with a so-called liquidation preference, and if you might get a credit from a bank. But that then means that you will no longer get an investment from an investor, because the bank with their credit is going to be paid first in case the startup does not succeed. So bank loans are not for risk investments like startups. So even if they seem attractive at almost no interest rate, they make no sense whatsoever for startups. The topic of valuation. This was a question we had in the very beginning. How do you put a value on a startup? The answer I found during the last year is, first of all, it's more of an art than a science. And maybe a lot of investors will disagree and say, well, our experience tells us that the startup in this and that stage is valued that much. But really, we have gotten a spread that is huge on potential valuations. So you're not selling an off-the-shelf product. It's really like selling an art. So in the end, the market decides what your value is. So if multiple companies are interested or multiple parties are interested to invest in you, the valuation, it gives you more choices, which might drive the valuation up higher. So it's really a supply and demand thing in the end. Then another learning, which is important, be clear on the definition of post-round and pre-round valuation. We had a lot of confusion on that one, and it can make a huge difference. So if somebody says, well, the valuation of this startup is 15 million, we're investing 5, the question is always, is this 15 post or pre-round? So read up on that and look at the definition, be very clear about it when you talk to potential investors. Then very important, whatever valuation you claim you want, you have to justify it, of course. You cannot just go out with a number and you will get asked the question, well, why? And then you need a proper explanation. So there's a couple of things that can help. Obviously, your reach milestones are important. So your track record has impact on what you value. Then comparables help. If there are comparable startups in your segment with a similar business model that have done financial rounds, it helps to show that. There is a lot of data. If you do a little bit of research online, you'd be surprised of how much information you find. So comparables help a lot. And then what we did in our case, but again, realizing at early stage that makes no sense at all, we actually then did this discounted cash flow model and calculated a so-called DCF value with the model and a so-called terminal company value in 10 years. So that was a pure outlook. And of course, again, you can make up whatever numbers you want, but you need to explain why and how you can reach them, and then you can argue. So talking to US investors, for them, for example, if you tell them, well, and then we're going to hire 100 people in the first 6 months, they will accept that. That's in the mind of a US investor, that is feasible. That's a good plan. If you tell that in Switzerland, you will get a couple of question marks on how exactly are you planning to hire 100 people in the next 6 months. That's then really a culture difference and a different way of how the startup world works. They're a lot more aggressive in the US than here. Then, and this we have heard from Désirée before, the team is the most important asset for the investor, and that includes advisors and board members. So they are part of the team. They were very important for us. So when we got feedback, we were lucky to always have a very positive feedback on the team, and always they mentioned extremely strong advisory board and board of directors. So you're in the end, you're selling an idea and a plan and a vision, and the only tangible thing is the team. So it is really important. And then again on valuation, the topic, really negotiate with the lead investor and not with the co-investors, because if the lead investor says yes, that's his role. So interestingly, I had a lot of potential co-investors that wanted to invest small tickets at the minimum ticket size, and then started negotiating on valuation. And we immediately said, look, I don't want to have this discussion with you, because that's what we do with the lead investor. That's his role, and also the privilege he gets, because he puts in all the work, the due diligence, the negotiation, term sheets. So he also defines the term. That's what the lead investor is for. So again, try not to waste time. I have wasted way too much time on this with potential co-investors. Then a couple of things on financials, and here again I have an engineering background. It's important to read up on the basics of how financials work. So how does a capital increase actually work? So you create new shares. These shares are then sold. You're not selling shares that you already have. So there's a couple of learnings that we did on the go. I did not know this before. The good news is this stuff is not really difficult, but you need to read up on it. You need to know what a balance sheet is. You need to know what a profit and loss statement is, and you need to know what cash flow means. Again, it shows it's super easy, and it shows a lot of professionalism if you do know it. And it's the first time that you will really, come into these financial topics when you're raising money. So it helps if you know the basics. So read up on them. If you feel unsure, get help from someone who knows the stuff. There's a lot of coaches in this area. I actually did a 2-day coaching session with a financial expert to learn all of this. Work the charm. I feel like I have a solid understanding of how business financials work, even though I haven't studied this topic, at least enough that I feel comfortable talking with investors about it. Quickly, the process of a financing round, and give me a sign of how much time I still have left. Sorry, feel like I've been talking too long. I have to stop. Okay.
We should soon come to the Q&A because we already have quite a lot of questions, but you can summarize it in maybe 1 or 2 sentences or.
Yes, so I will. So a process of a financing round, it will take a year, so start early. Be prepared of a lot of pitching. It can be frustrating, and then again, get a lead investor first and try to get term sheets signed as soon as possible. Be ready for the due diligence, so have all your data in a data room ready. And then don't be shocked of how much paperwork it involves. And also there, get a professional to help you, so a lawyer to help you on shareholder agreements. And then once you've reached the milestone, don't forget to celebrate the success because that tends to be forgotten in the daily stress.